Hello and welcome to Pro Trader Strategies Market Commentary for Monday, June the 11th. Hope you guys didn't miss me too much last week. Tried to get in some of these daily market commentaries, but it was a whirlwind of a week to say the least. Anyway, on with a couple of things I need to talk about real quick. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. Not a whole lot in terms of economic data today. It is a Monday, usually pretty quiet here in the United States for economic data, but across the pond, they usually don't always follow that rule. And out of Great Britain, we actually got some pretty good data, not good data as in it looks good, but good data for overall economic picture. So let's take a look at it. Over in Italy, we've got the Italian industrial production came in at negative 1.2%, expected to be a negative 0.7%. Italian production, really industrial production, isn't a major mover of the European area, so it's really just not a very strong number. Plus all the stuff that was going on in Italy, we knew that they were going to have a bit of a pullback. But one thing we didn't really necessarily expect was that kind of pullback in Great Britain, and that's what we're starting to see. Manufacturing production month over month came in at negative 1.4%, expected to be a positive 0.3%. We also got trade balance came in at negative 14 billion, expected to be a negative 11 billion. Great Britain construction output came in at 0.5%, was expected to increase by 2.4%. Industrial production came in at negative 0.8%, was expected to be a positive 0.1%. So no good economic data out of Europe today, and especially pretty dismal economic data out of Great Britain. Now that being said, this week is the week for the FOMC. They should be coming out with interest rate probably increase this week. And then I think they're going to kind of taper off on some of that rhetoric going forward about raising interest rates throughout the rest of the year. I think that this would be a good time to raise and then pause, at least for a couple of cycles, to see how everything shakes out, because we are not seeing extremely great economic data. So that would be something that would make me maybe raise one more time and then hold off. All right, so that being said, let's get on to the overall markets. We can see that the crude oil futures are moving slightly higher today by about 23 cents, but bumping up against this 38 Fibonacci level. Now, it didn't really seem like it was going to be that big of a deal on this 38, and at one point in time I thought about pulling it out, but we can see that now off of this bounce, we are starting to see resistance come in at this 38.2 Fibonacci extension level. That being said, it looks like it wants to maybe roll over a little bit. All right, gold futures moving higher. Nothing really to be said here. It's just up a couple of dollars, but for the most part, it is trading sideways and really hasn't moved for them. It's not making a big breakout move. Bitcoin futures, on the other hand, dropping dramatically today, almost 1,000 points off. A lot of this has to do with stuff coming out about regulatory environments, different countries not allowing it, and things of that nature caused a bit of a drop today. I still believe that this market needs to go down and test that 58.80 level in order to really build a nice base and show value to everyone, that when it gets down to those levels, that's where people really want to get in. So that being said, I think it needs to go down there and test it at least one more time, or at least come very close to testing that 58.80 area. Bonds unchanged. I think that they're going to probably remain right around here with the Fed interest rate hike priced in. But going forward, I think we're going to kind of trade sideways here. But this week, probably pretty quiet for the bonds. Oh, the VIX, the teens were short-lived, it seems like, just a few months. But there's still hope. We're down at the bottom. Probabilities, our volatility is going to go back up. That's what I'm looking for. So this would be the opportunity to start buying that volatility. You know, I've been talking about that lately. You got to sell high, buy low on volatility. That's the way you trade options. So when the volatility is this low, we need to start looking for opportunities to buy options for that increase in premiums due to the increase in volatility. All right, so Dow Jones Industrial Average, pretty unchanged for the most part, up 7 points. We can say that that's unchanged for the Dow. I mean, it could be in a heartbeat that goes back to unchanged. NASDAQ up 14 points on the day. Our Fibonacci level that we talked about when we drew this as the Fibonacci and then the extensions, those two lines coming in together act as a lot of resistance here. So that being said, NASDAQ has a tough row to hoe to get above that 50 Fibonacci extension level. As you can see, we tested it a few times, but have not been able to pierce through. And it being a Monday with light volume, I don't really expect a lot going on, no economic data to trade on. It's going to be really sector rotation is I think what we're going to see heading up into the FOMC. We've been seeing a lot of retailers really do well recently, and I talked about this during earnings season, that these guys were giving us good good data on their earnings, but they were giving these forward guidance that I thought were a little bit iffy at best, that maybe they were given bad forward guidance so they could scoop it. Well, it seems like that's been the case where the overall retail sector has been doing very well in this rally, while the tech sector has not been doing as well as, say, the retail sector. It's been more of the lagger. I think that now we might start seeing some of this rotation back into tech so that they can take advantage of the upside here. So I'm looking to rotate ahead of that or get in position ahead of that. And that being said, let's just do one more chart and look at the 30-minute breakdown of the E-mini S&Ps. As you can see, we are very close to the highs of the day. Overnight inventory pretty neutral for the most part, but today's market action into the open really seems pretty bullish. Don't see a big major sell-off happening with the feel in the market today. All right, let's talk about a couple of things that I've done. Macy's, I played this to the downside. It's all on my theory of we've seen this nice big rally in retail off of some of their earnings that they said, hey, you know, our forward guidance isn't so great, things of that nature. I think we topped out here, maybe a bit of a correction. We've got the confirmation from Friday that it was going to be a top. Today, it's kind of try to erase this. So with all of that being said, I'm playing this to the downside, but I'm going to have a very short leash on it. If this chart pattern is broken to the upside, say it prints 41.34, I'm going to be out of this. That'll be breaking of that. Or if it settles up there, I should say, that'll break that pattern and I'll be out of it. But I'm looking for a bit of a rollover here in Macy's from those highs. So I did this both in my margin and in my IRA. I bought some puts in there in Macy's and did the August puts. Bought the August 36 puts for $1.20 in there, looking, like I said, for a correction to, because this is just low volume, big rally. I think we'll cover and fill in some of this volume, which will be beneficial to my Macy's trade. Now, on the flip side, AT&T has high implied volatility. So what do? We sell vol in that type of situation, right? So I went into the July and sold the 36 calls in there for 50 cents. I did not. In Macy's or AT&T, I went in and sold the 36 calls for 39 cents. Sorry about that. Getting AT&T confused with my Macy's trade. So sold some calls in there, looking for a bit of a correction. Not looking that great today, but high implied volatility. I got to try and take advantage of something like that, right? In my margin account, that's what I did for the AT&T naked short calls. But over in my IRA, I had to do that with a defined risk, going out and buying that one option for a nickel or less. So I went in and did the for AT&T, I sold the July 36 calls in there, bought the 41 calls to define that risk, and collected 34 cents. So that's that nickel difference there, playing that to the downside. and added Macy's as well. So both those trades in my IRA and in my margin account. That's all I got for you guys today. This week's webinar is going to be a good one. We're going to be expanding on these diagonals and doing more calendars. Now, I'll show you the nuance difference between a diagonal and a calendar. They seem like they are very close, but they are very different the way that I set them up, and I'll show you those different rules to help increase your probabilities of success with the long put calendar. Excuse me. All right, that's it. If you can't take that, take it easy.